Okay, this is episode like literally 10 of the series. This is going to be hopefully the easiest one that we can ever understand, ever use, ever need, ever look at. It's going to be equilibrium. What is it? What are we doing? Okay, let's start off on the fucking blank screen like everybody does here. Let's just draw ourselves a little bit of a trend to the upside here. Why the fuck is my thing? Why the hell is my thing like this? Why is it so squibbly? Holy. Okay. Let me just zoom out a little bit. I think it's yeah. I'm on the 4 hour. I don't know why it's so squibbly, but let me. Besides the point. There we go. Okay. How does the market move? We know that it moves in trends. We know that it moves up and down and up and down. It doesn't normally just go straight up. As we can see within these points, we're probably going to have maybe a fair value gap like we talked about yesterday that we tap into, or we're going to have fair value gaps get inversed, and then we are going to see maybe price go down lower into another point. And it can always mean, it doesn't always mean that price is going to just instantly reverse as soon as we go through these fair value gaps, as we notice, because they can sometimes go down into a point which we call equilibrium. And we can see that the trend is going to continue off of those. Another point, just like a fair value gap, if a fair value gap doesn't work out, we can use what's called equilibrium. Let me drag myself over here so you guys can see the chart a bit better. But if we are going in an uptrend, how can we confirm that we are going to continue and go higher with this leg right here? Well, we can draw from a swing low, a low of a candle, a low, like we know in the series, I already taught it to a high point right here. And I'm just going to drag it over here so that it covers the whole place. I use a tool called the Gann box that we favorited on day one, literally day one. We are going to open this up. I can show you guys the settings by just clicking here. You're going to make 0 and 1 black. You're going to turn off everything. It's going to look fucking crazy when you open this up, and it's going to have like a bunch of numbers, a bunch of lines. We don't even need that. Just don't even worry about it. Just copy the settings right here. Make it like red or some like really bright, colorful color that you're going to see on top of everything. Blue, red, green, whatever. It doesn't matter. I like to do the red, and I like to just have 0, 0.5, and 1. So you're going to have the 50 point of the exact range. Well, what does equilibrium show us? It shows us the premium and the discount of the range. So this top part from this to the middle point in this whole area here is going to be the premium in a uptrend. So if we have a uptrend and we are up here at the top, are we going to be wanting to place orders here when we're at the top of the exact range? No, probably not. We're probably going to want to buy when it becomes discounted and we become underneath this line right here, the 50 point right here, into this whole area down here. We're probably going to want to buy and place orders so we can get a better price, a better discount on our orders to be able to send price to the upside. And what does that mean also? That means the same thing for the downside. So if we have a trend that is going in lower lows and lower highs, like this right here, we're probably going to want to draw from swing high to a swing low down here, swing high from swing low, and then we're going to see that price can normally, most of the time, tap into equilibrium and then be able to continue to the downside. Now, if we wanted to take a trade off of this, this would mean that we would probably want to see either a fair value gap or equilibrium or both get hit at the same time. Sorry, it was up to here. Maybe we have a fair value gap, price comes into it, comes and taps it. Maybe the equilibrium lines up perfectly with the fair value gap. This would be a really good thing to look for a trade right down here if we had a continuation, like another fair value gap gets inversed, or if we break structure down here. Now you can kind of see how it is all coming together, how we are all putting these things all together to be able to do a actual entrance into a trade. So it's going to get a little bit more complicated from this point on in the series. Hopefully you can understand these confluences. Hopefully if you don't, you just go back and rewatch the videos and you'll be able to understand them. Hopefully I explained them well enough so you actually know what you're looking at. But we haven't actually gotten into any strategy. I hope you guys are able to just look at these and kind of understand them, kind of get to know them a little bit. I want to identify some issues with what people think equilibrium is. So if we are looking on a chart, it's going to probably be from the most recent swing low to the most recent swing high in the market. Are we going to draw to a point which has not been formed in the market yet and draw from all the way down here to up here? No, no, because it has not formed in the market yet. It's not there. It doesn't actually exist. We can only draw it when it actually starts to show us confirmation that we are going downwards. So if this point started to get a rejection and a rejection candle down like this, and we had one candle form like this, then we could draw it onto the chart like this. We could draw it like this. And we can see that, equilibrium of the range is going to be right down here. And then we can say like maybe the next candle comes down and it fills that. And then we start getting reactions to the upside, or we don't, and we just keep going downwards. Either way. But we can draw it only when we see this part of the leg get formed. If we just have this and price is still continuing to go up and up and upwards, we're going to keep extending equilibrium all the way up here until we actually get a down candle like this, coming back down to the downside to give us that equilibrium range. Are we going to be drawing equilibrium like this, from this high all the way down to this low? No. Why? Because there's a low right here that's already here. Like, you need to draw from the most recent swing high to the most recent swing low. What are we doing? Stop. And then we haven't formed a down candle over here, so we're not drawing from here to here yet. We understand that, hopefully. We're not drawing from up here all the way down here just because we feel like it. No, there's another low right here, perfectly fine that we can draw from, right there. Just put it right here. It's not that hard. If there's another low in between here, if there's another one that got formed like right here, then you're gonna put it right here. It's not gonna be down here just because it looks good, because it looks all right. No, it's gonna be the most recent swing low to the most recent swing high. That's basically all it is. Are we going to draw from here to here? I want you to answer real quick in your head. No, we just addressed this right here. We're not drawing from some imaginary point in the market that hasn't even formed yet. We're drawing once we get a confirmation that this is going to be up candle, and we can see that price has the potential to come back up here and fill this 50 point and give us a discount in this range up here from this area right here. We're in a premium right here. We're not drawing anything until we get this exact candle that shows us that we're going to come back up, and we're going to see a blue candle right here. Not drawing until we see that. Are we going to draw equilibrium from here to here? Answer: yes. Yeah, that's pretty valid. You can draw from there. And then what do we see? We see that market comes into this discounted area, and then we see that we get rejection back to the downside. Okay, hopefully that was all right to explain, so we can have it in either direction, up or down, and then hopefully we can show you guys on multiple time frames how we use equilibrium to show us market trends. So we can see, if we go into replay mode, right here, we have a downtrend right here. How do we know this? Because we come down and we break structure right here, and this is today's price action. So we broke structure right down here to the 4 hour. Are we going to draw equilibrium from here to here? No, because we don't have an up candle right here. So we don't have equilibrium yet. We don't have it. Are we going to draw equilibrium right here to right here? Yeah, we can. Do we see that it gets filled? No. So it didn't have the opportunity to do so. But if I play price out a little bit, right like here, if I select a bar, boom, can we draw equilibrium from this swing high up here down to this swing low right here? Of course we can. We definitely can. What are we going to see when we play out the market? Boom. What are we in now? We are in a discounted price range. We're in this range from 0 to 0.5, and we can see that the market is giving us a discount. And can I show that we react off of it? Yes. So we mark into this discounted range, and then we see that we get reactions based off of that. So the market moved up into this discounted range, and then we ended up taking a sell down to the downside. Now we didn't have any fair value gaps, so this is a good example of how we can use EQ, equilibrium, instead of a fair value gap, and we can still have the same confirmation. These are the two confirmations that I use to show that a trend is going to continue to the downside or the upside. So if we have a trend that we want to see, maybe we'd see like a fair value gap here in this equilibrium, or maybe we'd see that a fair value gap is just above the equilibrium. We can use both of those to show us a confirmation that we are going to go higher or lower. If we drop down to the 1 hour time frame, let me see if I can find something right here. None of these are good. None of these are good. Let me go back over this way a little bit. Can we see right here? No. Can we see right here? Yes. Okay, so let's bar replay this a little bit right here. What do we see? We see that market is in an uptrend. We see that we are starting to make this down candle. We already closed the down candle. So what can we do? We can draw from this swing low down here, the most recent low, all the way up to this most recent high right here, because we have a black candle and a blue candle and a black candle and a blue candle. Boom. Okay. Where's equilibrium of the range? We have equilibrium right down here. Equilibrium's down here. What do we also have? We also have this fair value gap right here. So if I play out price, we can see that we come down into equilibrium. We don't quite hit this fair value gap right here because we don't need to. We don't need to. We have this equilibrium that we can trade off of. We can see that we get reactions based off of that to the upside. So that is one way that we can use equilibrium to show us a good continuation and how we can continue the trend. If we go down to the 5 minute, we can see this playing out in real time. We can see this playing out every single time frame because price is fractile, and it will work every single time frame. It has the potential to. It doesn't need to necessarily work out in that way. Very choppy today. Holy. See if I can find something right here. Let's do this. Not really, no. Okay, maybe we'll do this right here. No, this isn't a good example. Let me pause it until I find one. Okay, yeah, this is decent. We can see that we have a 5 minute downtrend right here that's forming. We have broken structure to the downside on this candle right here. And then we monitor the most recent highs, didn't break anything up here, didn't break anything up here, and we're still continuing downwards this way. What do we do? We put in a swing high right here in the trend, put in a swing high, and then as soon as this candle forms down here, we have a swing low, and what do we see? During that swing low being created, we also filled equilibrium of this range, and then what do we also have right here? We have a fair value gap that was already tapped into right here. But we can see that if we progress price forward, what do we want to do? We wanted to push more into the discount and another time into this fair value gap right here that is inside of the discounted range of equilibrium. And then we were able to, what? Get reactions downwards off of that, back down to the downside, fill our orders right up here. The big market makers were able to fill their orders, get a bunch of money accumulation, discounted prices on all of their entries, and then they were able to push price downwards to the draws that they actually wanted to take out down here and probably even further down. Yeah, bang. So we make equal lows and then end up messing around and coming back up. Again, not necessary for price to keep continuing there, but it's a good example of how equilibrium was able to be shown, and how a fair value gap can be incorporated into that as well, and why we use fair value gaps and equilibrium. If we see right here, boom, we can see that price is coming down into a fair value gap. We wouldn't really have a equilibrium to use on this 1 minute because equilibriums on the 1 minute don't really get respected that often, but we see that, boom, what do? We reacted off this 1 minute fair value gap. We can see that if we had not this high up here, then we would have come straight back up here and not hit equilibrium, I guess, but we did hit a fair value gap and then ended up going back up to the upside. So those are the two continuation confluences that I use on a daily basis to be able to find entries and show continuation of a trend that is forming within the market. As we can see market doesn't move straight upwards in straight up candles. Most of the time we move down, then up, then down, then up, then down, then up. And during those retraces where we have a down like this, we can see that fair value gaps are getting filled during this leg, and how we can see equilibrium getting filled during these legs as well. So I want you guys to find a couple of these examples. Obviously, higher time frame holds higher power, so a equilibrium tap on the 4 hours is going to be more effective than a equilibrium tap on, say, the 1 minute time frame. So maybe find yourself a couple of examples on the 4 hour, 1 hour, and then see if you can scale down into lower time frames and be able to spot those. Maybe take a couple screenshots so you know what they look like. But that should be this episode explained. So hopefully you understand what a equilibrium is now and how we can use it to identify the trend continuing in the direction that we want it to, and how discounts are able to fill market makers' orders. Okay. Peace out. Episode 10 done.